The standard 7A program.
The 7A loan program is the SBA's most common small business program. Its name comes from Section 7A of the Small Business Act, which authorizes the agency to provide business loans to American small businesses. In this lesson, I'll walk you through key elements of the 7A program.
The 7A program helps creditworthy small businesses acquire financing when they cannot otherwise obtain credit at reasonable terms. The program covers business borrowing requests in which the business has sufficient cash flow to repay the loan, but may not have the necessary collateral or history required by a bank's lending policy. 7A loans can be used for long and short term working capital, revolving funds based on the value of existing inventory and receivables, the purchase of equipment, machinery, furniture, fixtures, supplies, or materials, and the purchase of real estate, including land and buildings. The construction of a new building or renovation of an existing building, establishing a new business or assisting in the acquisition, operation, or expansion of an existing business, or refinancing existing business debt under certain conditions. Borrowers are prohibited from using 7A loan proceeds to refinancing existing debt where the lender is in a position to sustain a loss, and the SBA would take over that loss through refinancing. Effected partial change of business ownership or a change that will not benefit the business. Permit the reimbursement of funds owed to any owner, including any equity injection or injection of capital for the business's continuance until the loan supported by the SBA is dispersed. Repay delinquent state or federal withholding taxes or other funds that should be held in trust or escrow, or pay for a non sound business purpose. The maximum loan amount for a 7A loan is $5 million. In fiscal year 2021, the average approved 7A loan amount was $704,581, and about 10% of all 7A loans exceeded $2 million. The SBA guarantees 85% of the loan amount for loans of $150,000 or less, and 75% for loans greater than $150,000. The maximum amount of the loan guarantee is $3.75 million. The eligibility requirements are the same as what was discussed earlier in eligibility. The business must operate for a profit, be considered a small business as defined by the SBA size standards, be engaged in or propose to do business in the United States or its possessions, have reasonable invested equity, use alternative financial resources, including personal assets, before seeking financial assistance, be able to demonstrate a need for a loan, use the funds for a sound business purpose, and not be delinquent on any existing debt obligations to the U.S. government. Loan maturities are based on the ability to repay, the purpose of the loan proceeds, and the useful life of the assets financed. The maximum maturities for SBA loans are 25 years for real estate, 10 years for equipment, and 10 years for working capital or inventory loans. The 7A loan terms are much longer than most banks, especially smaller banks and credit unions, tend to lend. A common loan structure for these lenders is repricing every 5 years, balloons, in other words, all outstanding principal due in 10 years, and amortization terms of 25 years. The SBA 7A loans have no balloon term. They can fully amortize over the loan term limits described above. In addition, the loan interest rate could be fixed over that term. This is why some borrowers would prefer an SBA loan to regular loans that banks or credit unions provide. Interest rates may be fixed or variable. The repricing frequency must not be more often than monthly, and it must be consistent, for example, monthly, quarterly, semi-annually, annually, or really any other defined period. The rates are negotiated between the borrower and the lender, and they're subject to SBA maximums, which are pegged to the lowest of prime rate, the optional peg rate, a weighted average of rates the federal government pays for loans with maturities similar to the average SBA loan. These rates are the index rate or base rate. A spread is added to this rate to arrive at the full rate paid by the borrower. That spread is negotiated between the borrower and the lender subject to these caps. Here are the caps for fixed rate loans. You will pay some guarantee fees to the lender, most of which will be passed on to the SBA. This is how the SBA funds itself. For all loans with maturities of 12 months or less, the fee is 0.25% of the guaranteed portion of the loan. For loans with maturities that exceed 12 months, the fees are in this table. You may have noticed in the earlier slides that the rate of the fee is set by the full amount of your loan, but the fee is only charged on the guaranteed portion of the SBA loan. For most 7A loan programs, the SBA can guarantee up to 85% of the loans of $150,000 or less and up to 75% of loans above $150,000. Processing fees, origination fees, application fees, points, brokerage fees, bonus points, and referral fees that could be charged to an SBA loan applicant are prohibited. Lenders can charge a late fee not to exceed 5% of the regular loan payment. For loans with a maturity of 15 years or longer, prepayment penalties apply when the borrower voluntarily prepays 25% or more of the outstanding balance of the loan and the prepayment is made within the first 3 years after the date of the first disbursements of the loan proceeds. The prepayment fee is as follows. During the first year after disbursement, 5% of the amount of the prepayment. During the second year after disbursement, 3% of the amount of the prepayment. During the third year, 1% of the amount of the prepayment. These prepayment penalties can be much lower than the standard penalties of banks and credit unions for long term loans. For 7A loans of $25,000 or less, the SBA does not require lenders to take collateral. You will be required to pledge the asset being purchased as collateral. Also, if you have enough fixed assets and real estate to fully secure the loan, you'll be required to pledge collateral to collateralize the loan to the maximum extent possible up to the loan amount per SBA guidelines. If business assets do not fully secure the loan, the lender may place a lien against the principal's personal real estate, residential, and investment to the extent necessary to ensure that the loan is fully secured. The SBA directs lenders not to decline a loan solely on the basis of inadequate collateral because one of the primary reasons lenders use the SBA guaranteed program is for those applicants that demonstrate repayment ability but lack adequate collateral to repay the loan in full in the event of a default. Individuals who own 20% or more of a small business getting an SBA loan must provide an unlimited personal guarantee. Borrowers don't get 7A loans directly from the SBA. You get 7A loans from lenders like banks and credit unions. That lender will decide if you qualify for a loan with them. They will also determine many of the details for your loan, like rates, subject to the SBA guidelines discussed above.